Well, good morning and welcome from London to today's FS Club webinar. Today's topic is one that's been running for quite some time, really the last half decade and a bit more: Brexit, ending the city's dominance of European finance, ? And today we have European expert Graham Bishop, an old colleague of mine, a friend, and in fact a past master of the world traders who preceded me as past master. And I note a number of world traders actually on the call today. Well, before we get into things, just a few words, if I may. You'll know me. I'm Michael Mainelli. I'm one of the directors of Zien. And it really is a privilege to be able to introduce so many of these FS Club webinars. And we can only do so thanks to the generosity and tolerance of our sponsors. Tolerance is a much overlooked word, I often find, but it is a very good word and a very good trait. Our sponsors like to see debate across technology, economics, and finance, and allow us to range widely and freely and bring these webinars to you. Now, today we're going to follow a fairly traditional format. I'm going to get out of the way as quickly as possible so you can hear from our expert. And then Graham and I will be having a conversation for about 20 minutes after his presentation. So letting him get the main arguments out of the way and then move into the presentation. We also have one poll for you, so we're looking forward to you participating. If I may address three quick questions that typically come up. The first is that yes, the slides are available, and in fact they are already posted on the site and in the chat room, as you'll have seen. Secondly, yes, this is being recorded, and the recording will be available in approximately 2 working days, so probably early Tuesday. But third and most importantly, how do I participate in the conversation? You use the GoToWebinar question and answer facility down there in the chat room and send questions through, which I will see. All of the questions, comments, observations that you send through will also be sent to Graham afterwards, and he can reply to you individually because they will have your email attached. So please don't WhatsApp me, text me, WeChat me, Signal me, email me, message me, because I'm here with you. So please do feed them through that facility, which I think is the best way to handle things. Now, if I could, Graham, if you're ready, the floor is yours.
Right, thank you. So next slide, and then the next slide again. Here we are. Right, good. Now I want to start by just talking a little bit about diverging interests. And I use the word interest because it always, to me, conjures up the reminder of Lord Palmerston's dictum about nations have no permanent friends, just permanent interests. So one of the things to look at is what are the permanent interests which are at work here. And the first one, just to be very quick about it, the EU's permanent interests is a political one, no doubt about it, because of the effects of the 30 years of war from 1914 to 1945. So how to stop that again? We all know the Churchillian approach to that. The modern latest manifestation of that is in the mission statement and actually the manifesto on which UVL, if I may, was elected in 2019. That is her manifesto, and this is the key part, the Agenda for Europe 2019-24. And that's the 24 is the reason why I've chosen that sort of 5-year span we're talking about. So here you have their statement. Now, when you look at what they've done since, what the Commission has done since, DG FISMA's had a work plan. I glanced at their consultations. There's 19 consultations when I last looked, and that covers more or less every aspect of financial services in the EU. So this is the consequence of the Lamfalussy process many years ago, that there will be a review of all these measures and that there will be an updating of them. So what we can be fairly sure of is that virtually every aspect of the EU's financial services regulation will be reviewed and probably changed quite significantly. And it may not be completely in force by 2024, but it will have been agreed. So the EU is driving on with its interests, and frankly, it's not going to take any particular notice of the interests of a former member, which is much smaller. So I've then put what Chancellor Sunak has said, just a couple of things there. I could have added the comments from Andrew Bailey, the governor, about he was strongly advised not being a rule taker. So I think, and it's also to remember here that the UK committed to use its best endeavours to comply with the any new standards coming from the global standard setters, and of course implementing the current ones. So the UK has already agreed to take some rules, but it hopes to be in the, not going to say driving seat, but certainly at the table when those rules are created. So next slide. I think it's always worth just keeping strongly in mind the relative size. Everyone hears the phrase that the UK is the 5th largest economy. It's probably India is now ahead, but that's beside the point. The main thing is that both population and GDP, the EU is massively bigger. Is it 4 times, 5 times, 6 times? Who knows? But investment assets, when we're talking about capital markets and financial markets, it's investment assets which I think are relevant. And the EU 28, just underlining that includes the UK in this data, is 25 trillion, of which the UK was 6 for UK citizens and 3 for foreigners. Remember that the EU savers are far more committed to using bank deposits as a long-term savings mechanism. So this underlines one of the reasons why the EU wants to get the capital markets union going, increase the scale of those investment assets as much as possible. So if we could move to the next slide. Now, when are we going to get the questionnaire? Is this?
This is it.
How do
Graham, wanted to ask the audience a question. What do you view as a key issue for market activity? Folks, I'm launching that poll. Graham, asking for your thoughts. Is it 1, equivalence, 2, the trading of EU shares, 3, the trading of euro derivatives, 4, the trading of euro bonds, or 5, the use of English law? Those are some tough choices, Graham. As ever, our audience exceedingly fast. Almost half of them have voted.
Right.
And well, now we're up to 3/4 having voted. And it isn't an easy choice. I'll be quiet on which one I think is the most important. I'm going to close the poll in just a second with 3/4 of the audience having voted, and giving it time there. And we're now ready to close. And I'll now share those results with you. And a very, very strong, clearly very, very strong, 63% saying this, if they have to choose one thing, obviously equivalence. So back to you, Graham.
Oh, could I just make a quick note of that? I think English law was 22.
No,
so that's Eurobonds 3. Okay, right. That's very interesting. Well, that's extremely interesting. Okay. So next slide for me. Well, this is a bit of a problem. The TCA was very clear, the Treaty on Cooperation Agreement, Trading Cooperation Agreement. And when you look at the Commission's Q&A, just to take the shorthand, the agreement does not include any elements pertaining to equivalence frameworks for financial services. These are unilateral decisions of each party and are not subject to negotiation. So as far as the EU is concerned, this is completely at their autonomy, and they've been very, very clear about that all the way through. And when you looked at the, going back to the negotiations when they started, I remember some of the documents had repeated iterations of they are going to maintain their regulatory autonomy. And so in financial services, that's exactly what they've said they're going to do, and they will do, except when it's in their, they believe it's in their interests. Otherwise, there will be no comprehensive statement of equivalence. So that's yes, I'm sure a number of people will just be disappointed by that, but that's the way it is going to be. They will give us equivalence when it suits them and no other occasion, and it may be temporary, as we'll come back to. Now, trading of EU shares. We already know that went to Amsterdam, of EU shares, mark you, that went to Amsterdam pretty quickly. And then, and I think that's pretty well, nobody is concerned about that. In terms of tax revenues and employment, etc., I don't think that's a huge question. Trading of equities nowadays is all done on screen online, so there's no blue buttons and people in top hats running around trading floors as there were when I first started. So that's already gone. Now, derivatives trading, that was not so. That was one of the third most important thing, and I can understand why, because a large liquid market, derivatives are the core of that nowadays. So derivatives trading has already moved significantly in euros. Now, Mark, so I'm not talking about dollars or anything like that. And IHS Markit have done a couple of very interesting surveys. So let me just give you some of the data there. They did this for the first quarter of 2021. So the EU share on MTFs and OTFs grew from less than 10% in July 2020 to a quarter in January 21. So from 10% of the euro swaps up to a quarter went to Europe. The UK's share fell from 40% in July 2020 to 11% in January this year. And the SEF, the swap execution facility, in other words, the US share went from 10% midsummer up to 19% this year. So we've clearly seen a major migration of euro-denominated derivatives. And that's not surprising. We know the pressure to do that, so it has had some effect. Now, the question is, what is going to happen when the temporary equivalence runs out in mid-22, the CCPs? There was a speech given by Leon Panetta of the ECB in March, beginning of March, which was, to my mind, laid it out very clearly what their thinking is. There are other statements from ESMA around the same time. But Panetta, I think, made it very clear, as far as I'm aware, this was not covered in the UK media at all. But the ECB, of course, is the issuer of the euro and therefore has a direct treaty-given interest in what goes on with the payment system in euro. So Brexit has made it urgent to consider the extent to which the EU should rely on non-EU countries for critical infrastructure. We have the equivalence decision valid for 18 months. Meanwhile, industry stakeholders, that means many of you out there, industry stakeholders are encouraged to reduce their exposures to UK CCPs. Now, the Commission has set up a working group with EU authorities and industry to address the issues involved and to facilitate the transfer of derivatives contracts denominated in euro and other EU currencies to EU CCPs. This is going to be done. At the moment, the big CCPs in the UK, which are tier 2 CCPs, are in fact subject to ESMA's supervision for the moment. Anyway, ESMA has set up this working party to address the risks to EU financial stability. So this is a very clear economic rationale for doing this. It's not to be nasty to the UK or anything. It's to safeguard the EU's stability. And as part of its responsibility for issuing the euro, given in the treaty, the euro system has a voice in all this. So ESMA may recommend the Commission deny the UK CCP's recognition after this. So that's going to be very carefully examined, and that may be the outcome. But if it were to be the outcome, the ECB, Panetta goes on to say about that would make our own domestic clearing system not fit for purpose. So there would have to be a big set of changes in that. So, and almost certainly that would have to become authorized by EU authorities to have control rather than the national authorities. So there are some big issues for Europe, or for the EU behind this as well. But the bottom line is, sometime in early next year, as the temporary equivalence decision comes up for termination, for running out, we can expect the EU to have made up its mind. And the tenor of what Panetta has said here, others have said from the chairman of the working party, make it pretty clear that they, unless they can be convinced that their financial stability is safe in the hands of the UK government, and when you think about the potential breaches on the Northern Ireland Protocol, if I were them, I would certainly wonder about that. Anyway, so unless they are convinced, they will set about over a period encouraging and maybe even forcing market participants to use EU systems, euro area systems, to do their euro-denominated work. And of course, that then brings in the question of will market participants decide to co-locate their dollar activities with their euro? Who knows? Up to us. So let's move on then to the use of English law, which I see that came out quite high. That was the second highest.
Yes.
And this is very interesting because we all know that the city, well, London, let's be more precise, is a very large supplier of legal services to the rest of the world. English law is the dominant system for bond prospectuses and so on. The Lugano Convention a few years ago was created to allow judgments by EU courts and EEA courts actually, to be enforced throughout the EU. So there's no point in having a bond prospectus which gives you rights to seize collateral if you can't enforce it. You've actually become unsecured de facto, and I think those bond investors who thought they got collateral might be dismayed if they found they can't enforce it. So at the moment, the Commission has recommended to the Council that the UK not be allowed to participate in the Lugano Convention. The UK is, of course, upset about that. And the decision in the end is a QMV decision by the member states. So that is not yet over. But when the Commission has been so clear-cut about it, I suspect that we will finish up not being in the Lugano Convention. Does this matter particularly for bond investors? I think it does for corporate bonds. The volume of corporate bonds outstanding is relatively modest, about 10% of total euro-denominated bonds outstanding. Half, of course, is governments, and they issue under their own law for obvious reasons. So 10% of the volume outstanding is corporates, 20% is banks, well, monetary financial institutions, to use the right term. And they are being encouraged at the moment and shortly will be obliged by ESMA to issue under a legal system for new bonds, which includes bail-in. In other words, the BRRD is enforced like that. So English law, would they permit the major chunk of the finance of the banking system to be subject to the rule of foreign countries' Supreme Court? We have made a big thing about not being subject to the ECJ. It's good for the goose, it's good for the gander, I think. So I would be surprised if ESMA doesn't continue to push for all that to be under EU law of some sort, but we don't need to worry about where. So I think the role of English law is set to be diminished quite substantially in the bond market. Elsewhere, who knows? But in finance, that's where we are. Now, my final point here, and I'm just keeping an eye on the time, is the rules for sustainable finance. Everyone is now making a big effort on sustainable finance, the green economy, climate change, etc. So what we're getting is a push on both sides of the balance sheet. What are investors allowed to buy? What should they be taking account of? So that's the supply side. What should banks be doing with their bank lending? So that's the supply of finance. On the other side, the companies and users of the money have got to disclose what they're doing with the money. And this is where we come to the famous taxonomy, the green bond rules, the taxonomy, all that sort of stuff is being pushed forward by the EU as a complete action plan for the very specific purpose of taking global leadership and first mover advantage. They then make no bones about it, that's the plan. And we're all enmeshed in these discussions about these long phrases of strings of numbers and letters which one loses track of terribly easily. Anyway, they've got a complete package is now being assembled. It's not yet gone through the legislature, but the plan is that they will have first mover advantage doing it by the globally. Now, what is going to happen for the UK? Are we going to go along with that or not? There's a very interesting report from the City of London Corporation, which I might just cite, on data direction and dialogue, opportunities for UK-US collaboration on climate-related financial services. So the proposal in this paper, and I take it as fairly authoritative, I'm sure Mike will tell me if it isn't, but it argues that there should be UK and US should collaborate, and that the international dialogue should be led by the UK and the US in the development of globally consistent standards. When it comes to disclosures by companies, by investors, by investment funds, etc., insurance companies, all these bodies, disclosures should avoid being duplicative. Policymakers in the UK and the US should work to establish deference mechanisms. Now, so the UK is going to defer to the US. No mention I see there of deferring to the EU. Maybe that's significant, maybe it was an oversight. Anyway, I think that's something which is going to be quite a problem as this gets going, as I do my weekly run through all the latest events of the week. I see a constant stream of events coming out from the International Accounting Standards, IFRS, and IOSCO, and so on, all of which is paying careful attention to the existing EU proposals. And of course, there aren't any UK proposals, there aren't any US proposals, so the EU is in fact framing the debate as they expected. So next slide, please. So consequences by 2024. That's, as I mentioned, that's the end of this commission. So we should have seen quite a lot of legislative actions in force, well, certainly agreed and in force and maybe implemented by then, but market players will know at that stage what they've got to be doing. Now, there are two aspects here which are critical for the UK. First of all, tax revenue. And again, I cite the City Corporation's work on, very excellent work on this. 10% of tax revenues in the UK come from financial services, £76 billion. It's £5 billion per 1p on income tax, just as a handy ready reckoner. So if that income, that tax from the financial services industry halved, and I'm just plucking that out of the air, then replacing it would be the equivalent, and of course it wouldn't all be done this way, but the equivalent of raising the basic income tax rate from 20 to 28p. So everyone in the country would feel that big time. It may not come from income tax, it can come from somewhere else. This isn't going to happen next year, it will be steady. And when you see a limited number of jobs have already moved, more jobs have been created over there as well. But we're now seeing pressure from the ECB and ESMA and so on banks operating in the UK to make quite sure that they really have got their systems and their people, actually to be more precise, in place on the continent, so they genuinely can run the business from there. And with the people goes income tax revenue, goes spending, and of course corporate tax revenues will shift as well. If the profits are all built up on the continent and the costs are still just borne by the UK parent or subsidiary, whatever, then there will be an impact on corporate taxes paid in the UK. So if this begins to take effect in anything like the scale which I'm suggesting here, this will be something which every citizen in the UK is going to notice the impact. And this is, of course, before COVID. So just to finish then, current account deficit, I'm terribly old-fashioned in thinking this is important. I've lived through too many crises of current accounts. In the end, I always remember Governor Mark Carney's comment about being careful about relying on the kindness of strangers. The current account deficit has to be financed by strangers lending you or investing in you one way or another. The OECD numbers here show us to be the worst performer for, I've just put the last decade here, you could go back further, as a percent of GDP, so given the proportion. We are more or less the bottom consistent performer all the way through. At the moment, well, since the autumn, the current account deficit forecast by the independent forecasters was lowered from 70 billion deficit to 90, and they're expecting something like 100 billion deficit next year. It's early days to know what the real impact is from COVID, of course, and Brexit. Trade patterns are so muddled. But I was interested to see the other day an academic group, and I've forgotten what the name of the body was, have just published a report saying that already financial service exports are £110 billion lower than would have been predicted had we continued with the growth path from 2016 from the referendum. So that's not yet an absolute reduction, but it's the tremendous trend which has been the UK's saviour for the last couple of decades. That's looking as though it's plateaued, shall we say, and worse may be to come. So I just ask you to keep that in mind. The taxes and the current account earnings, which used to be generated by the city, and some portion may move overseas. I'm not saying all, but some portion, and that would be the result of the UK, the city, no longer being dominant in EU finance. So at that point, I will finish my remarks and look forward to some comments and questions.
Well, Graham, actually, I'll stick to this slide because we do have a few questions on this. There are quite a few questions in common, so we'll need to be fairly sharp here. In this slide, there's one OECD member swinging wildly. Do you happen to know which one that is?
The one on the right, the extreme right, that was Ireland. And the dip before, I forget which country it was. It is not the same country each time.
Oh, I see. Okay. All right. Well, we've got a few things here. Let's start really with Hugh Purser's question. Is really you've highlighted the potential halving of tax, but is there a current best forecast, or were you just doing this to show sensitivity?
To show sensitivity. Okay. At the moment, it's certainly the income tax question. It'll be years before we know the answer.
Well, because Oliver Jory goes on to say, well, you know, how far can the UK tax take from financial services at 76 billion be expected to fall? You pluck 50% out of the blue, that's fine. But European finance is only one part of city business, surely.
Yeah, yes. I made the point when we were talking about derivatives. Will the industry decide to co-locate dollar activity with euro activity? The euro is the second largest currency in the financial markets by mile. Yes, it's half dollar activity, but if you want to have the benefits of the two desks sitting beside each other, you co-locate. So there will be pressure on dollar stuff to either go to New York, and I showed the numbers of SEFs, or to co-locate to somewhere in the euro area.
And then we got a couple more comments and questions on this. So, for example, Kieran Walsh, given the predicted current account deficits, will sterling start to weaken going forward and end with higher inflation? And Douglas Andrews asking, is there a consensus view of the impact on the current account deficit or the value of sterling going forward?
I've been a bear of sterling for a long time because of this current account and our productivity question. But these are matters which are outside the debate about Brexit in the city. Low productivity and the impact on our exports, the impact of our 40% of goods trade which goes to the EU, non-tariff barriers which are now appearing as we're not in the single market. All of those are factors which we will have to see over time, and I don't think anyone can say I know exactly what's going to happen.
Okay. Angel Gaviero, I think, gives you some ammo here. You know, he's wondering, what do you make of the UK 10-year yield compared to EU government yields widening since Brexit to reach levels of Italy and Greece?
Quelle surprise, as they say in France.
Okay. Christopher Croft, who is the CEO of London and International Insurance Brokers Association, points out that you've focused quite a bit here on sort of the traditional capital markets that people believe the city is all about. But the city's about a lot of other things. So what about areas such as insurance distribution, where there are no equivalence provisions in the relevant EU directive?
Yes, well, that's true. I mean, how broad can one go with this sort of discussion? I agree entirely. There never has been anything to do with equivalence in the insurance, in Solvency II and so on. So there won't be any equivalence. That's I can't imagine why the EU is going to suddenly decide to give equivalence when it's not doing it in other key areas.
Mhm.
The EU is not giving equivalence full stop unless it's essential in their interests. And that I think we've got two examples, one of which I've quoted, the derivatives exchanges, CCPs, where to cease equivalence overnight would risk financial stability. So let's do the sensible thing and have a transition period.
Okay. Oliver Jory asked the same question in a different angle. He's saying, could you make some remarks about non-trading services in the EU, for example, mergers and acquisitions, advisory, and insurance?
Yes, M&A activity and advice. Yes, what is that subject to? That is a MiFID regulated activity.
It can.
Yeah, so it would have to be. I would have thought that there will be pressure to make that be done in the EU, but how exactly you do that, and whether it's all very well to say bond trading, where is the back office, where is the risk manager, etc., etc., but where is the lawyer who is advising on M&A transactions isn't quite the same. That's a specialized topic. I wouldn't like to comment particularly on that, but the whole point may be that the legal structure, and I go back to the Lugano Convention example, that there will be a move towards EU-based law, whether it's Luxembourg or Irish or whatever, German, French, and therefore the lawyers who are qualified and expert in that will have a certain edge over the English lawyers.
Mm. Mm. I want to come back to the Lugano Convention. A couple of good comments here on that, but just to bottom out some of the stuff about the trading areas. Graham Elliott is curious, what would stop London retaining most of the back office functions for the foreseeable future?
Delegation. The EU has made it very clear all the way through that they will not agree to delegation of critical functions. And the back office is obviously fairly critical. If you don't settle a trade, you have a problem. So they've made clear that all that sort of stuff has to be located in the jurisdiction of the European Union. Whether that's Euroland itself or the Eurozone itself is another question, but within the EU's. I must say, I've never forgotten many years ago, I had a very pleasant lunch with a senior French official in Paris, and it was when Salomon Brothers should be moving its bond trading. He said, in the end, Graham, if something goes wrong, I want to be able to send a gendarme to arrest you. So that's the ultimate power of the state, is to make quite sure that the rules are obeyed and they can get hold of miscreants, as we have seen regularly recently.
Okay. And two other questions, and we'll have done, I think, most of this. Eric Veerman, is full migration of IRS swaps to UK CCP from UK CCPs to EU CCPs feasible? And if not, what would happen?
Well, I don't know. That's a very technical question. What I can see being feasible is that new swaps will finish up having to be done over there, and therefore over time the whole book will shift. As I recall, the maturity spectrum is very short term, but of course there are some serious amount of stuff which is very long term. So that may be rather like the transition from LIBOR. We'll finish up with some legacy issues which will be difficult. But I suspect even if new trades were done there, we would effectively have shifted the bulk of activity over 3-4 years.
Well, I'm pleased you mentioned a couple of, as an alderman of the City of London Corporation, I'm very pleased you mentioned a couple of our reports, and we do study this closely. Tim Skeet, who's in banking, says the EU appears to have adopted a smash and grab along national lines with no one financial center. Do you see this changing? Should we expect the EU to form a better plan and perhaps start to group activities? And could this help the city?
Well, Tim is one for giving very strong statements. Yes, there is no smash and grab as a central plan. And it is interesting to find that for some reason exchanges have migrated to Amsterdam and fund managers to Dublin and to Luxembourg and so on, there were already well-established bodies and exchanges and things there. So there is a certain, just in the same way that Lime Street is the centre of insurance, and Threadneedle Street and so on. So that geographical location is not being pursued, not being enforced or even thought about by the EU. There's no need to, particularly when we're working from home. Where do you connect your computer to? Do you connect it to a server in Amsterdam, or actually, of course, it's not in Amsterdam, but Iceland or somewhere? So it will just evolve according to market pressures, and the market pressures will include the capacity of people to get houses and school their children and all those facilities which people actually need.
Yeah. Well, there are a couple of interesting comments here. Anita Dorothy Millar says there's an interesting story on Bloomberg today regarding the experience of JP Morgan and half of its equity traders quitting in the face of being asked to move to the EU. And people matter. Stephen Murgatroyd comments, will the advent of new technology that disintermediates back office functions render any of these discussions less relevant in the future? But I'd like to turn to a question from Jonathan Price, which he asked early on. Is the refusal, well, sorry, just before that, you were speaking earlier, and Chancellor Sunak is saying that we can do it better regulation. Is the refusal of the London Stock Exchange to consider listing crypto ETPs comparable to its insistence on applying fixed commissions to Eurobond trading in 1963, when it was asked to list the first ever Eurobonds, the result of which was the entire business of listing Eurobonds moving to Luxembourg?
Yes, well, I wasn't in the city at the time, so I can't quite remember that. But no, cryptocurrency as well. We could debate the merits of cryptocurrencies for quite some time, but I would not be at all concerned. I think cryptocurrencies is going to be like the black tulip bulbs of Amsterdam in centuries gone by. But that's a personal view. The fact that the London Stock Exchange is being sensible in not participating in such a thing, I think, is very good.
Now, one of the great theories. Sorry, go ahead, Graham.
I was just going to say about half the equity traders shifting, not shifting, resigning. So if you go back to the UK's tax revenue, those are high-paid, high-taxing jobs. They stop. I don't know what these people will do instead, because clearly they won't be getting equity trading jobs in London. Otherwise, there wouldn't have been JP Morgan wouldn't have had to move it in the first place. So either they take a big pay cut, or they themselves move to Amsterdam or wherever it might be and decide, right, we better join this. This is our career. So I don't see that as being a real problem. And the more everything is automated, the less there is need for human intervention, unfortunately. So I can imagine quite a lot of banks seeing major resignations of high-paid staff will be quite relieved they don't have to sack them.
We've got a number of points here speculating on the euro, and I'm not sure I want to dive into that, but I would like to recognize them. Bob McDowell says the euro will undergo some more pressures in response to increased inflation over the next 5 years, which will have an enormous impact on the southern European states, and he questions the camaraderie of Eurozone members. Trevor Hilder wonders, does the euro really have a future? It seems to be a badly designed currency, and if it blows up, what future is there for the EU? But I'd like to return to your point earlier about the Lugano Convention. So the Lugano Convention was the EFTA members, Switzerland, Norway, Iceland, and Liechtenstein, as I remember, in 2007. But Peter Cousins is asking, to what extent will the 2005 and 2019 Hague Conventions mitigate the effect of the UK failing to accede to the Lugano Convention?
Well, I'm not a lawyer. My understanding is that the Hague Convention is not a complete substitute by a long way. And as far as the simple thing which a bondholder wants to know is, if the corporate defaults and I've got security of on flow of invoices or a factory or land or whatever it is, can I seize that? And as soon as you start talking about factory and land, you're into all sorts of problems of land law. This is why insolvency procedures in the EU and some countries are so notoriously slow. So I don't see that the Lugano Convention can be easily replaced. And the first time there is a bond default and the holders suddenly discover that they can't enforce a UK court judgment, there will be, the bondholders will take notice. Okay. Maybe too late, but they'll notice.
Bob McDowell again.
Should I just comment on the euro for a moment? Clearly, if the euro blows up, then given it's so central to the EU's political goals, then the EU, I have little doubt, will also blow up. So this will become all redundant. And it is for that reason I expect the euro area to make huge efforts to make sure that the euro doesn't blow up. And we've already, due to the force of the magnitude of the COVID situation, begun to see a fiscal union, the outlines of it kicking and screaming and so on, but the outlines beginning to appear. Nobody is claiming that the construction of the euro was perfect from a theoretical academic point of view at the beginning. There were many loose ends left undone. I wrote about them, I've been writing about them for 30 years, but it is being forced by events, dear boy, events are forcing them to happen, to get together and stay together.
I'd like to turn to standards for a second. Anu Bradford, who's a professor at Columbia Law School, brought out a book, I think it was early last year, called The Brussels Effect, How the European Union Rules the World. And her basic thesis was that it's become a leader in establishing standards worldwide. And so one of the wedges here, and I'm pleased you referenced the City of London Corporation report on U.S. cooperation over sustainable finance that came out last month, but it was a pretty tentative report saying, wouldn't it be nice if we did something? Whereas the EU has, a heavily established taxonomy. And in fact, Jose Alzola says, there's a trend towards global rules and standards in finance, biz, FSB. Then how far is the UK going to be able to deviate from these global and EU rules and practice? Or are we just adding, as a country of 65 million, yet another taxonomy to the green debate?
Well, let's just take first the question of the EU rules, the Brussels rules. I first became aware of this in 2001, 2, whenever it was, when the EU decided to apply international accounting standards everywhere, because they couldn't agree on French accounting standards or German or British or anything. And that made IFRS. And then we had, of course, US alternatives. US rules didn't quite match up. But the EU, as a very specific policy, realized that they could set the global standard, and they did. And now we have the Digital Market Act trying to set global rules for tech companies. We've got GDPR for privacy, and now we have the green rules. Now, the point about international standards is that they are not terribly granular. They are big picture. When you read Basel III or Basel anything for that matter, these are aspirations with a certain amount of detail. But when it comes down to, does Bank X, can they count this item in their capital or not? What is the definition of capital? That needs to have really detailed, in Lamfalussy speak, level 3 practical details. And that's what the EU is doing. So taking and influencing, because the EU sits on all these international bodies, so the EU will be able to shape those as they change to make its rules, its detailed rules, be the go-to rules from the overarching principles of the FSB and what have you.
Okay. Well, as ever, thanks for coming in, for leading a really interesting discussion, answering quite a few questions. I'd like to conclude in the minute we don't have available with 2 points for you to comment on. First is Hugh Purser says, this paints a pretty bearish picture for the city in the UK. What are the positives? What should the city be doing to grow its global presence? And I can't resist this lovely comment from Marcus Johnson. Luckily, I'm sitting on the ground floor, so jumping out of the window will not hurt. But before I do so, is there anything you can say positive about the future for the city?
Well, Howard Davis, formerly of the FCA, etc., wrote an article just quite recently about the golden times of the city are over. There's no doubt the city will continue, and I obviously hope it will, and its livery companies and so on will continue to prosper, but not in the same way that they have done. And what is a simple thing the city can do which avoids these difficulties? I don't know. I've thought about it. I've been asked many times. I've been on calls where other illustrious people have been asked exactly that, and there's a sort of muttering and long silence.
Mhm.
It is not obvious how to get out of what the UK electors have decided to do.
Well, Graham, as I say, we have run to time, and if I may, I'm going to give three quick rounds of thanks, if I may. Firstly, as ever, to our sponsors. I hope you found this interesting. You know, Brexit is the gift that seems to keep on giving, and there's always yet more to be done, and supposedly it was finished. I'd also like to thank the audience. You've been particularly vibrant today. All those questions and comments will be sent on to Graham, and he can get back to you. We have a very full week next week, starting off with Professor Douglas McWilliams on how to create a knowledge city, and going forward on to ending, in fact, with a fascinating area on the library of mistakes in finance, which I think you'll find intriguing. But as ever, go check out the website. But Graham, you know, you're bearish, I'm bullish, but I don't think either of us would think that the way ahead is not going to be a hard one. We've supposedly worked hard to take back control, but what we need to do now is use that control. Certainly things like our approach to cryptocurrencies and other areas are angles where we haven't yet seen an opportunity to use that control, or if we have seen the opportunity, we've shied away from it. So I think it's going to be very important for us to get that mojo back if we're going to go ahead. And as you indicate, relations with the EU, they may not deteriorate, but the direction of travel is one of an increasing union,
Yes.
bringing its own finance together, and that having some impact on us, regardless of what the precise numbers are. You've given us some of that sensitivity, and I found that very enlightening. And so I would like to thank you. Unfortunately, I am unable to open the floodgates of applause from the audience, but I have, as ever, my Korean karmic clapper,
Right.
substitute for applause. I'd like to thank you so much for appearing and wish you and everybody else a great weekend.